Good morning and welcome to the Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us after this long weekend. It was a good one, hopefully, for a lot of people, myself included. So thanks very much for joining us. Coming up on the show today, Nadeem Kassam, Chief Investment Strategist and Portfolio Manager at Manoa Private Wealth Council, will be joining us for the hour. In 30 minutes, we'll get the latest read on Canadian inflation numbers in April with Jimmy Jean, Chief Economist and Strategist at Desjardins. And we want to hear from you this morning on First Call. Reach out with your questions on North American large cap stocks, and we'll have Nadeem answer as many of them as he can at the end of the show. Number to call, 1-855-326-6266. We'll open the phone lines in about 30 minutes. And our email address is firstcall@bellmedia.ca. Now, some of the stories we're tracking for you in the BNN Bloomberg newsroom. Agnico Eagle is moving ahead with a large gold mine in Canada's far north. The company has given the green light to the Hope Bay mine in Nunavut and plans to spend more than $2 billion on initial capital costs. The project has been hailed by the federal government as an anchor for economic development in the Arctic. Shares of Home Depot are moving to the downside after a key metric in the retailer's latest quarter missed expectations. Sales at locations open at least a year rose 0.6%, slightly below analysts' estimates. Adjusted profit beat expectations. Home Depot's business has been hit by elevated interest rates and high housing prices, which have sparked a pullback in home purchases and upgrade projects. And now our top line story. Canada is likely going to see inflation rise again, driven by higher global food and energy prices. According to a Bloomberg survey, year-over-year inflation is expected to increase to 3.1% in April. At the same time, global bond yields have jumped to multi-decade highs, pushing up borrowing costs in Canada and reinforcing the view that interest rates could stay higher for longer. Let's digest all of this with our guest for the hour, Nadeem Kassam, Chief Investment Strategist and Portfolio Manager at Manoa Private Wealth Council. Nadeem, thanks as always for joining us after a holiday weekend. Hopefully you got out and enjoyed some of it.
Oh, thank you for having me. Yeah, it was great. Weather was nice and sunny this weekend, so that was always a positive for the long weekend.
And it was, and we come back to talk inflation.
Oh yeah.
What are your expectations with it?
Well, what we're seeing, globally is inflation inching higher, and that's the top line headline reading, right? And that includes food and fuel prices. And so, no surprise here, right? That the Hormuz crisis is spilling into global CPI prints, and we're seeing it in the U.S. and likely see some of that spill over here in Canada as well.
And how long, depending on who you talk to, some people say by June it might be over the oil pressure, but you're thinking longer.
Yeah, look, I think that everyone is hopeful for a June resolution, and that's both the EIA as well as the IEA, for example. And I know the Trump administration would like to say that this is going to be over sooner than later. The reality is that no ships are moving through the Strait of Hormuz, right? And so it's anyone's guess. And as long as the strait remains closed, that's 20 to 40% of either gas or crude that is not moving through that key corridor in the world.
And we've been drawing down, I think people aren't noticing it as much. We've been drawing down huge reserves, and not us so much, but everywhere else.
That's exactly it. So, everyone was causing or calling for, this immediate crisis. At the start of the war, there's been certain safety nets that have supported markets and supported crude prices from soaring to even higher levels. And that has been, coming into the year with, high inventory levels as well, right? And so we've been drawing significant volumes on a daily basis. And if we look at just April and March, we've drawn through global inventories to the tune of about 200 million barrels. That's pretty significant given where inventories were prior to the start of the crisis.
And then bringing it back to what we mentioned off the top, bonds, where does that leave them? Where does it leave you with them?
Yeah, so look, the Hormuz crisis is obviously pushing yields even higher, right, in terms of inflation expectations. But there have been other underlining points that have been really percolating behind the scenes. So the trade war is another factor that's been really weighing on inflation numbers. And then you factor on the deficit spending. We're seeing that in Canada. We're seeing that in the U.S. and probably even more so now going forward, just given the crisis and the disruptions that we've seen as a result of the Hormuz crisis, right? So again, that ongoing supply of capital coming to market or need for capital in the market, and then central banks kind of stepping away or not playing that role, we're probably going to see yields kind of pushing higher further, possibly. And inflation staying elevated as well.
I was going to say, because that'll put pressure on mortgage rates, that'll put pressure on lending, everything, right?
Yeah.
And could that be a vicious cycle then? Could we see that between oil prices high and that drives bonds up, that drives rates up?
I think the markets are repricing, right? And so the move that we're seeing now is a function of what investors are anticipating going forward, right? And so it's hard to say if the majority of the move is kind of behind us, but I think a big part of it has occurred in the past month or so, right? So I think there is risk to the upside. Again, if these, the actual war in Iran and the Hormuz crisis is not resolved soon, and then also any resolutions on the trade front. So again, there are current factors that could, push the inflationary print even higher and yields thus higher. But again, a lot of that is very dependent, funny enough, on two key things. And I would say for this year, likely the Hormuz crisis
is the big one. How long can we absorb it, you think?
Yeah, look, I think what we've seen is modest demand destruction so far, likely in Asia, and we're seeing it even across Europe with jet fuel prices, jet fuel inventories, and so that's been resulting in airlines essentially, shutting down certain flights to certain regions. Again, not that detrimental to their business in terms of demand, but again, we're starting to see those early signs. But again, if this doesn't get resolved, we're going to start getting more of that demand destruction. We're going to get more rationing, so on and so forth, right? And so again, it's not a good story for the markets going forward. Again, it really adds to the stagflationary perspective that many have been talking about. And again, that gets worse as these crises, fail to get resolved.
And how are you weighted in the markets right now?
So look, we still like equities, and we'll probably go through some of our ideas and how we're positioned, and even kind of what's been happening in markets globally. But we still like equities. We think that it's a stock picker's market. There are definitely pockets of opportunity across all sectors, but there are certain areas that have consistently been hitting the mark in the U.S. and Canada, and also internationally. Within the bond complex, again, that's a challenging perspective, especially for most investors that are having a 60-40 split between those two asset classes. The reality is you want to be lower duration, just given the uncertainty on the inflationary outlook, and having some real assets within the portfolio. So that includes some alternatives, but then also having some companies within the equity basket that, again, have these natural or built-in inflationary hedges.
Okay, we're going to wrap it up on that note.
Perfect.
There, but lots more to talk about when we come back. Up next, earnings are beating expectations by a wide margin. The real story may be hiding under the surface. We'll have more on that after the break. See how things are shaping up on the markets, and we'll start with U.S. futures right now. And it is a little bit on the downside. It was not quite as off earlier, but you can see the NASDAQ another day down. Uncertainty, bit of a sell-off, of course, tech stocks, and that's driving that down. You can Dow up by 0.22, the S&P 500 by 0.39. Heading to Asia. And the Nikkei off by 0.44. The Hang Seng on the plus side by 0.48. The CSI 300, it was up by 0.4. And South Korea also off today on a bit of a sell-off with the chip makers. And heading over to Europe. Everybody in the green. It's up by about a half. CAC 40, a little more than a half. And the DAX, look at that. It's up by 1.1%. TSX from Friday, of course, the long weekend. It was closed yesterday. It was down on Friday. We'll see what happens today. I expect much of the same, off by a 1 1/4, back below 34,000. Some of the winners and losers from Friday on the TSX. Bird Construction on their earnings up 14%. Strathcona up by almost 7%. Wesdome Gold Mines down by 11.4%. And Curaleaf off by more than 13%. Heading to the metals, everybody in the red right now. Gold, about 45.50 roughly, off by about a 1/4 point. Silver, back below 77, down to 76.44, off by 1.3. And copper also off by 1.37, but still well above $6. Western Canadian Select from Friday was up. It closed up nearly 4% at 83.77. What is oil doing today? It's a little bit mixed. Let's see where it's at right now. Yeah, it's off by 0.34% right now for WTI, down to 108.29 after surging. Well, the earnings season in the U.S. and Europe came in stronger than expected, led by solid U.S. results. But once you strip out big tech and AI winners, the gap with Europe is a little smaller. In fact, quite a bit smaller. Let's get more on this one. Nadeem Kassam from Marnoa Private Wealth Council. Nadeem, the tech and AI are everything right now for the U.S., aren't they?
Sure. On the surface, we are seeing strong performance out of tech and the AI names, and that's in the U.S. And even if we look abroad, around towards the emerging markets, Korea, Taiwan, and so on, they've been very, very strong performers year to date, and we've seen good numbers out of that region as well. I think if we look at the S&P 500 as a whole, while we've seen a lot of the strength within tech and the AI-centric names, broadly speaking, we saw pretty good growth, very strong growth, in fact, across the cyclical complex, right? And so that's not only including tech, but also financials, consumer discretionary, consumer communication services, financials, and so on, right? And so, that has been the key bellwether and the foundation for, funny enough, markets so far this year, right? And so that's been a key highlight. But again, we've seen a predominant level of strength within the AI-centric names as well as the Mag 7.
Would you call the market healthy overall?
Well, when you look at the underlying strength in terms of the various sectors, I would say yes. I think it's very healthy. Numbers have come in very strong. So 22% earnings growth, which was better than expected, and the beat rate has been well above what we've seen historically, both on the top and bottom lines. And we've seen this in Europe, just not to the same degree. And we're seeing a broad-based, kind of earnings season where companies have come in better than expected. And it's been the cyclicals as opposed to more of a defensive posture that's come in, with really strong earnings. So again, that gives me confidence in the outlook. And again, there's obviously a lot of the geopolitical headlines and noise that have caused obviously a lot of volatility. But again, I think when you kind of strip away all of that noise and you see kind of what companies are saying, what companies are actually reporting, both top line and bottom line, because it's important to understand where that growth is coming from, whether it's on the cost side of things or if it's actual underlying consumer demand, and we're seeing the latter. So again, very supportive of kind of our outlook. But again, there were a lot of common call-outs that we saw from companies that were reporting, which named some of the risks that we've talked about this morning.
And what were some of the call-outs?
So some of them were, seeing consumers holding back. We saw Home Depot today, report, and they even mentioned the fact that consumers are holding back on big purchases, big spending, renovations, if you will. And we're seeing that across many of the retail names that reported. A lot of them are also flagging higher energy costs, right? So that's obvious, as well as just the trade uncertainty. So getting some resolution on that front. On the flip side, they saw, a lot of companies were reporting, positive investment in AI, and I think that was like a record number of mentions of AI investment, AI euphoria, if you will, which is a good sign. It's not about
That CapEx is being well spent.
That CapEx is kind of filtering all the way down to every different businesses. It's not just at the hyperscale level. We're seeing it at businesses across various segments and industries in terms of how they can operationally utilize AI, and also from a cost point of view, but also kind of incorporate it into helping with some of the revenue generation initiatives that they have on.
And what about Europe? How's Europe looking to you?
Europe numbers came in pretty good as well, 5% earnings growth, which came in better than expected. Top line was pretty good as well, but not to the same degree as the beat levels that we saw in the U.S. And over there we saw financials do well, along with energy and to some degree tech as well. Again, they don't have the hyperscalers or the extent of the tech industry that we have or that is present in the U.S. market. So more of a cyclically postured market. But again, given the pressures that is facing a lot of Europe, the companies came up with pretty good numbers again as of Q1, and that's only roughly a month of the Hormuz crisis that we've come across, right? And so again, there was some caution in the tape, if you will, but again, overall, fundamentally, it helps justify the moves that we've seen so far this year.
All right, and emerging markets, South Korea has been on fire again.
Yeah,
but
you know what? I think
that's on essentially two stocks.
It is, and again, I think that is a function of just what we're seeing on the AI hyperscaler demand build out that we're seeing globally. Again, when you think about where chips are made, they're made in Taiwan for the most part, right? Taiwan Semiconductors and so on. That is where the foundries are. A lot of the companies that we talk about, whether they're NVIDIA or Apple, and we'll talk about hopefully Amazon too, they're fabless firms. So they essentially design the chips, get it manufactured there. So again, there is strong underlying demand and there's a shortage of compute. And that is a function of just the underlying critical components that are just not available, right? And so there's strong demand, a lot of spending ahead of that, but just a shortage of supply. So that's been a strong catalyst for EM, specifically these more AI tilted markets, and then we think that's going to be supportive going forward.
Okay, we got to take a break, and we are going to talk about Amazon after the break. It is on Nadim's radar. He'll tell us why. All right, we are back with Nadim Kassam, Chief Investment Strategist and Portfolio Manager at Marnoa Private Wealth Counsel, and he's going to talk about why Amazon is one of the stocks on his radar. What are we liking about Amazon right now?
I think there's several things. AI, there you go.
There we go, we're done.
I know, right? One of the key things that we've seen across the Mag 7 is they came in and out of favor. So last year we had the broadening out of the trade, and call it November of 2025, and you started seeing these sell off, and that perfectly aligned with just the tremendous amount of capex spend that the Mag 7s or several of them were announcing, right? And so. When we take a step back, it's a name that we own. We own several of the Mag 7s. And what we like about Amazon is that it's more than just the AI trade. So first and foremost, it's the largest online retailer.
Yeah,
right?
And people will be surprised at how much Amazon is.
Exactly, right? And so that is a key part of their business. It's a lower margin business, but it is pretty sticky, right? And another key component, I'll get to the AWS side, but another key component is advertising, right? And that's been growing at a double-digit clip, 22% year over year as of the latest quarter. The area that we like a lot is AWS. And so AWS is by far the largest cloud infrastructure in the US and globally, I would argue. Questions around AWS has just been the monetization of the capex, and we're starting to see early signs of that, or we saw that in Q1, which was consistent with our views. So Q1, AWS revenues grew by almost 30%. Margins came in at upwards of 38%. And so the question prior to earnings releases was, are they able to grow revenues without any margin compression, right? And so there's a lot of bears out there really questioning that. not only did we get strong revenue growth, we got strong margin, strong margin levels, and we saw backlog upwards of 200 billion, which is the largest we've seen in the last 4 years. So, that is very supportive of the underlying build out of the AWS and AI infrastructure, and they're seeing underlying demand, and that's especially if we exclude Anthropic and OpenAI demand that was recently announced.
All right, I want to get to a couple others here.
Sure.
We're on a tight line on this
Sure.
one. CNQ. Is it the perfect Canadian stock?
Look, it's a great Canadian producer. It's the largest Canadian producer, one of the largest independent in the world. I think if we go back to what we're seeing today with just the chaos within the Strait of Hormuz, the shortages of crude in the world, inventories being drawn down at, call it, let's say, 13 million barrels a day, likely going forward until we get some resolution. This is a core name to own for Canadian investors. Again, who knows what happens with the Hormuz crisis, but again, it's a very high quality energy producer, long life assets, 31-year reserve life, and a very, very low cost of sustaining capital to maintain or get those barrels out of the ground. At a $40 break-even US dollar WTI, this is a cash flow generating machine, $13.5 billion expected this year at an $84 US WTI. So again, we're sitting at a well over 100 or slightly over 100. And I think it's a very attractive entry point, especially given that the company is going to start buying back shares at an increasing level once debt levels fall to about $13.5 billion on a net debt to cash flow. So again, the return to shareholders is going to continue and accelerate heading into 27. And we feel like it's a very strong, high quality producer that investors should own as a core holding within their portfolio.
All right, let's get to the last one, Brookfield Infrastructure Partners.
Yeah, so we talked about inflation. Inflation is not going anywhere, and it's definitely going to be sticky. I would refrain from using the term transitory, as we've seen coming out of the COVID crisis. Brookfield owns critical infrastructure globally, and so that's across transport. So think about roads, tolls, ports, utilities, midstreams, and also data. So again, this is another way of playing the data play without paying the hyperscaler multiple. Key things to know: 85% of their FFO is indexed to inflation. So if inflation goes up, this is a natural equity hedge within a portfolio. So we like that, and this is a company that has delivered time and time again, year after year. So they've delivered 14% FFO growth since 2009. Valuation looks attractive. So another name to insulate the portfolio from elevated inflation, especially if we see that going out forward.
All right, we've got to wrap it up there. But when we come back, that's what we're going to be talking about. Stats Canada releasing the April CPI data. We'll break those numbers down with Jimmy Jean, Chief Economist and Strategist at Desjardins. And of course, our phone lines will open soon for our first call segment. You can reach us at 1-855-326-6266. Send us an email, first call at bellmedia.ca. We have some breaking economic news for you now. We're just getting in the CPI data for April. And year over year, the survey expected 3.1%. It was actually 2.8%. And the excluding food and energy, the core year over year was 1.5. So let's bring in a little more analysis, a little more depth. Somebody who knows what he's talking about this stuff, Jimmy John. He's chief economist and strategist at Desjardins. Jimmy, thanks very much for joining us after the holiday weekend. Not as high as expected.
Yeah, pretty surprising there. With, of course, the impact we were expecting to see in gasoline. So that part is certainly showing up pretty strongly. But you are seeing some compensation, and I think the one of the components that seems to be showing a lot of weakness there is recreation. So it could be with associated with what we're seeing in travel, for example, and some of the changes in consumers' preferences that might be showing up. We'll wait to see more details on that, but it's a pretty. I would say it would be a very pleasing result from the Bank of Canada standpoint.
So what do you think Bank of Canada's response will be to the latest print, or do you feel they're still going to be in a wait and see mode in terms of deciding on the path forward for rates?
I do think so. I think it means that there's certainly not a huge rush, a big sense of urgency right now to intervene in response to the oil price shock. In part because the economy is certainly weak. We've seen the latest job numbers and accumulation of job losses since the beginning of the year, especially full-time jobs. Certainly the picture has been pretty concerning on that front. Just generally speaking, we're dealing with tons of uncertainty related to CUSMA, with potentially further trade-related action in the U.S. And now the inflation data is suggesting that we're still very much in an area that's comfortable for the Bank of Canada. There's no need to really be thinking that we have a demand-related push in inflation, and really that's what matters for the Bank of Canada. So if we have, pull sort of demand pull inflation, that's where it warrants a response. I don't think that's what the event is showing so far, especially when we look at core. Core actually decelerated, which is and very close to the Bank of Canada's target, actually. So I think for the Bank of Canada, it's very much wait and see, and to really assess where ultimately the data is leaning towards. Is it really a growth problem we're facing that's going to be dominant, or is it really the inflation problem, let alone the fact that a lot of that is expected to be temporary?
I just want to ask about the energy prices, up 19.2% year over year, and for gas, 28.6%. Is that all strictly from Iran, or were there other factors at play there?
I think it's probably mostly the Iran shock, although we've seen some fluctuations as well, playing up in natural gas. Certainly that was the case the previous month. So and natural gas in Canada trades more on a continental basis. So different drivers shaping dynamics there. But certainly the overarching theme right now is related to Iran. And it's not just in energy per se. It's also how over time this can be expected to affect other price components, not just because of higher shipping costs, for example, or higher insurance costs. So that will play in the price of various goods, but also in terms of how it can play in, especially in the agricultural sector. So, you're talking a big increase right now in the price of fertilizers, and that combines with the increase in the price of energy to compress margins at the agricultural level. And we know it takes a significant lag before that shows up in food prices. So this is certainly something that that the Bank of Canada will have to keep an eye on. But I think it's something we're going to see play out more next year rather than this year, where a lot of those components are fixed by contracts.
Jimmy, quick question. I know this is just one print, but if we look at just where core is sitting and even core trim, probably near the bottom end of the Bank of Canada's target. Do you feel, or what is your base case scenario for the Bank of Canada in terms of rates? Do you feel there is a scenario that you're assuming, a diverging path relative to the Fed and other central banks?
I think really the path of least resistance right now for the Bank of Canada is just to stay on hold, because you have a housing market that's not been doing well. You have an unprecedented level of volatility in population data. So we've gone from the fastest population growth to now seeing contraction. That creates a lot of it creates a lot of volatility and unpredictability in various areas of the economy. And then you have the Iran shock, and you have the uncertainty from CUSMA. You have the broadening of tariffs that was announced in April, and that's a big deal for some key manufacturing sectors that have been sort of holding up so far, hoping for something, some kind of agreement as part of that CUSMA joint review. Now it seems that we're not going to get anything substantive on July 1st, and it's just going to drag on. So you are seeing a number of businesses that are closing up shop and that are kind of throwing the towel there. So it's not really the right time to be concluding hastily that here we are with an inflation shock and we need to suppress demand when you have already exogenous factors that are likely to weigh on demand. So that's why I think it's just sort of an information gathering process for the Bank of Canada. And I would say this affords them a bit of time before having to draw some conclusions.
All right, I just want one last question. I'm not even sure you can answer. Building permits, I was just looking at the numbers here. The survey had it at 2.4% month over month, and it was 10.3%. Any idea why that might be? And if you can't answer, that's fine, because I'm pulling that one out of left field for you.
Yeah, well, I mean, I would say that this type of deviation from consensus is not unusual for that indicator in particular. It is good news in the sense that there's still that housing affordability issue. So to the extent that these building permits are residential building permits, and that they suggest that there's going to be more supply coming online, helping to alleviate those pressures, which in turn could increase Canada's capacity to welcome more people, more immigration going forward, because we know for population aging purposes, this is still essential. I would say this goes in the right direction, but again, a word of caution as to the level of volatility in that particular indicator.
All right, we'll wrap it up there, Jimmy, but thank you as always for joining us.
Pleasure. Thank you.
Jimmy Jean is Chief Economist and Strategist at Desjardins. Agnico Eagle is moving ahead with a large gold mine in Canada's far north. The company has given the green light. The Hope Bay mine in Nunavut and plans to spend more than $2 billion on initial capital costs. The mine is expected to produce more than 400,000 ounces of gold annually. The project has been hailed by the federal government as an anchor for economic development in the Arctic. Shares of Home Depot are moving to the downside after a key metric in the retailer's latest quarter missed expectations. Sales at locations open at least a year rose 0.6%, slightly below analysts' estimates. Adjusted profit beat expectations. Home Depot's business has been hit by elevated interest rates and high housing prices, which have sparked a pullback in home purchases and upgrade projects. Still ahead, oil markets are under historic strain. Supplies are vanishing fast, and it all comes down to Hormuz. We'll see what it means for investors and consumers after the break. And our phone lines are open. Nadeem Kassam is taking your questions on North American large cap. Call us at 1-855-326-6266. You can also email us, first call at bellmedia.ca. The International Energy Agency reports that only 13 million barrels a day are offline, and inventories are falling fast as peak driving season begins. Prices remain under pressure despite weaker demand with no clear end to the disruption. We look at what this means for oil, gold, and where investors are positioning. Now we're back with Nadeem Kassam, Chief Investment Strategist and Portfolio Manager at Marnoa Private Wealth Council. We touched on the Strait today.
Yeah.
It almost feels like a quiet day. Only one thread of pulling back attacks, and things seem very quiet.
Yeah, look, again, if we look at the tweets or the truths coming out of the White House, it's really, really difficult to assess the path forward, right? I think we have to focus on the facts, right? And so 250 million barrels barrels in total have been drawn from inventories, and 13. We've had a deficit of 13 million barrels a day since the start of the war, right? Like those are the facts.
Yeah.
There's also no crude moving from the GCC states through the Strait. So there is a shortage of supply, and that's not going to be resolved, even if the Strait of Hormuz is remarkably resolved. The situation was resolved tomorrow, right? And so I think that's what investors need to be cognizant of. And I think the headlines and the focus and even some of the agencies out there, as I mentioned, IEA and EIA, are hopeful for a June reopening, just given the fact that we've drawn down so much global inventories that it's going to push and add some additional pressure to negotiators on both sides to reopen the Strait. That is not conclusive, right? And so I think that's something that investors need to focus on.
What is the danger to that this hope that, well, by June, because I think we were hoping it would be resolved by the start of May, and now we're almost through May and into June.
Yeah, look, the goalposts continue to be pushed out wider and wider, and I think markets will react as these deadlines or these deadlines in the air kind of get pushed out, right? And so I think for investors, what that means is that if things don't get resolved by June, or what many are anticipating to be a June kind of grand reopening, whatever that means, if it doesn't happen, then we're going to see some repricing in oil, right? And so if we saw just yesterday lead up to Trump's announcement that, hey, I'm going to delay some attacks, crude was up. Brent and WTI. And that's the reality of it, right? Because markets are responding to the realities that we're seeing in the market, right? And so IEA, I think, is forecasting that, as I mentioned, right, 13 million barrels a day of a deficit going forward, right? And the worst is yet to come, given that we're all kind of heading out here in North America in our prime driving season, right? And so, again, I think I don't have a crystal ball. I hope you do, but
absolutely.
I don't know what yours is telling you, but I would say we're not in the industry or in the game of kind of hopes and dreams. I think we're really focused on making concrete decisions on evidence. And so energy companies and having some exposure to an asymmetric profile, should things not get resolved by this June deadline, is a suitable option for, I think, most investors.
And what about gold? Where does all this leave gold right now?
Yeah, so I think you have a barbell approach here within your kind of real asset portfolio exposure. If things worsen, like we saw, at the start of the Hormuz crisis, at the start of March, if you will, we saw U.S. dollar catch a bit, right? And so that's net negative for.
And it seems like it's pulled back, though, a little bit.
It's pulled back, right? And so if we get tensions elevated and continuing to move higher, if we expect inflation to, as a result of these of this blockage, to continue to stay elevated, that's going to push yields up. That's also going to put some pressure on gold. However, the flip side, if we do get some sort of resolution with some line of sight to some end result that's viable with ships actually moving through the Strait, that's going to be a positive tailwind for gold. So again, I think it's a strategic allocation. I would use weakness to allocate to either the commodity or buy some of these really great producers here in Canada that, for the most part, the names that we cover, the large producers, have very net debt of zero or modestly negative, right? And so very clean balance sheets, pro-shareholder returns, and so they're using capital in a very disciplined manner to be thoughtful in terms of new development and deploying the rest towards shareholders.
All right, we'll wrap it up there on that note, but still, we'll take a look at some of the notable analyst calls and recommendations moving the markets, including a bullish call on Tamarack Valley. All right, let's take a look at some of the notable analyst calls and recommendations. Roth Capital Partners has initiated coverage on Tamarack Valley with a buy rating, highlighting strong production growth in Western Canada and robust free cash flow. The company is actively rewarding investors through steady dividends and aggressive debt reduction, with the stock trading near 52-week highs. Williams upgrading Canada Goose from sell to hold. The broker raised its price target to $12. This upgrade follows a jump in fiscal Q4 revenue boosted by a surge in spring wholesale deliveries, despite an $8.4 million store impairment charge affecting recent profits. The brand maintains strong profitability with resilient gross margin. Melius and Citi both sharply raising their price targets for Micron, signaling immense bullishness on the memory chip maker. Both firms point to exploding demand for Micron's high bandwidth memory chips, which are critical for powering artificial intelligence hardware. When we come back, Nadeem Kassam will take your questions on First Call. Time for First Call and first email. And for that, we go to our email from Richie. With all this AI in the future, looking like it's going to take out software companies, what's your take on Constellation Software in the future?
So Constellation Software has been one of those sleeper compounders for many years, and the arrival of ChatGPT and the AI revolution has definitely casted some crosswinds into that sail, if you will. I think what we are seeing in communication from the company and just kind of sifting through the results in recent quarters, their view continues to be that AI is going to enable them to grow their business and be additive as opposed to a destruction to their business. So again, Constellation acquires mission critical software businesses. And so these are not single solution, but they are critical to the functionality of businesses within various verticals. We tend to agree. I think there is stickiness to a lot of these software companies that they've acquired in the past, but there are evident threats to them. So again, for us, we're in a wait and see mode, and we're looking at a lot of the software companies, both in Canada and the U.S., and waiting for just further clarity in terms of what the impact has been thus far.
All right. We'll move on that note. Yeah, it's a difficult spot right there, and trying to figure out what the next thing is. Next email is from Len. Do you feel with the limited new product coming on over the next 5 years, it will be really good for Allied and other REITs like Allied?
Yeah, Allied Property, if you look at Q1 results, they weren't that great. Some cost overruns, weakness on the overall FFO results that were down 40% year over year. It's definitely a challenging spot to be invested in terms of the office. I think there is a lot of product in office, and there's going to be, continued efforts from Allied to, rationalize that portfolio, and we're starting to see that. I can't say that we're at an inflection point yet, so I think being patient is critical, at least for Allied and many of its peers, before kind of looking at adding to the name.
All right, we'll get one more in here. This email is from Glenn. Do you think the Next Gen Energy and Denison Mines are takeover targets, and which would be the first choice?
Yeah, so look, they've announced possible merger between the two, and so that's a pretty interesting consolidation that, if it does occur, would be quite impactful for U.S. markets and kind of the utility energy space. So you're bringing a combination of traditional, conventional energy and renewables, if you will, into a single vehicle. I think this is potentially a reasonable outcome, but again, we'll see what regulators have to say about that.
Do you see some I mean, it feels like it's mergers that have been a little bit slow, but they're starting to pick up again.
Look, I think there's, so M&A activity, generally speaking, was slow in 2025, and we're seeing a slight pickup going forward. SpaceX is about to IPO. Definitely other names that are coming to market. If we look at a lot of the U.S. banks, they've seen a lot of pickup within their capital markets business, so we think that's going to be a strong follow through in Canada and probably for markets going forward.
All right, got to wrap it up there, but thanks as always for joining us.
My pleasure.
Again, thank you to Nadeem Kassam, Chief Investment Strategist and Portfolio Manager at Marnoa Private Wealth Counsel, for joining us today. Lindsay's up next with The Open. Trading gets underway in a little more than 30 minutes. Have a great day.